All right, so now, I promised at the beginning that we would at least think about this strange fact here. This strange fact here. Now at least we can understand maybe what this strange fact is. We're looking here at the swap curve, which is red, and the Treasury yield curve, which is blue. We would think, okay, that in general the swap spread should be positive over Treasuries. Okay? That is to say that the corporate bond rate should be higher than the Treasury rate. And if it wasn't, you should be able to make money. And how would you make money on that there? This is always, when you see a potential arbitrage and you ask, why is it stay there? Why isn't it gone? Okay? Ask yourself, well, what would make it go? How would you take advantage of this arbitrage? And what goes wrong with that? How would you take advantage of this? Well, the Treasury is yielding higher, okay, than the corporate. So you want to be borrowing at the corporate rate, essentially, and lending at the Treasury rate. So you want to be long a Treasury. So this is an arbitrage. You want to be long a Treasury, which let's say you finance in the repo market, using the Treasury as your collateral. Okay, and then you want to have the opposite position in the swap market, okay, which involves having a fixed rate here and a flexible rate here, right? Because that's going against that, and that's knocking out that. Okay, but what is that? If you have fixed on one side and flexible on the other side, okay, that's a long swap position. Okay, so that's the arbitrage that you would need to do. Now we know that just by reading the FT, we know that corporations are taking big advantage. Corporations that can borrow are borrowing like crazy. You know, they're borrowing at 30 years. They're taking advantage of this, okay? And what are they doing with that money? Okay, they're putting it in the bank or something. They're building up their cash positions, or they're buying treasuries or something. So that is an arbitrage. That's this arbitrage, as a matter of fact. They're just doing it on their own balance sheets with their own debt. Okay, and it's not enough. It's not enough. It's not closing this gap. Okay, so you have to tell some story, I think, about why people don't want to do that. Why they don't want to do that. Okay, and what is that? If you have this position, what are you doing? You're borrowing short and lending long. You're not taking any credit risk because it's the Treasury, but you are taking liquidity risk because you don't know if you're going to be able to roll this funding at all, much less at what price. And I think people don't want to do that. They're worried about that. There's a still, with all of this flooding of the market that we've seen with QE and so forth, they're worried about doing something like this. That's at least one possible explanation for this that connects up with this money and banking sort of point of view. Other people would say, well, they're worried about the capital constraints that are coming in, Basel III or something. And you know, you can always tell lots of other stories. What these stories all have to be consistent with, they all have to explain why nobody's doing the arbitrage that would close that gap, and has not done it for 4 years. Okay, this is a long time. It's a long time. The fiscal cliff is referring to this sort of manufactured crisis that's going on right now, where Congress has said if we don't come to agreement by a certain date, okay, then taxes are going to rise and all kinds of things are going to happen. And that's thought that will have big negative aggregate demand effects in the economy, and so people are worried about this. Personally, I think it's all political brinksmanship, okay, and it's a smokescreen for other things that are happening, but that's a longer discussion. I do think that if you were worried about this, you might want to stay in cash, you know, and so you don't want to be short cash. That's what this is, you know, where you're borrowing to buy treasuries. You want to be long cash if you're worried about that. Other companies, in fact, it was in today's paper there, they're also worried that maybe there's going to be an increase in taxes, and so they're dumping some of their cash. They're giving it away as dividends to their stockholders. So there are some dislocations that are being caused by this fiscal cliff. I think that's true. But I don't think that can explain this because it's been going on for 4 years. It seems that it was a consequence of the crisis. It's not particularly about the fiscal cliff. But there are distortions happening because of the fiscal cliff as well. Maybe we'll talk about those next week, next Monday. So interest rate swaps. This is an enormous market. Trillions. And you can see, this is where the prices come from. When a banker, a Jimmy Stewart banker, quotes a mortgage rate to you when you're trying to buy a home, where do they get that rate? They get that rate from here, because they are imagining that mortgage is going to be packaged with a bunch of other mortgages and it's going to be sold as a bond. And so what does the swap curve look like for mortgage-backed securities? That's exactly what they're looking at. That's where the prices come from. They come from dealers making swap books. This is where the prices come from. Not from sort of demand and supply of loans there's demand and supply of loans sort of behind the picture, behind the scenes here. But the place where the prices are made is in these dealer markets in derivatives. That's the way modern banking works.